Dividend ETFs are a popular choice for many investors looking for steady income, long-term growth, and a hands-off way to build wealth. They provide reliable cash flow, tend to be less volatile than growth-focused funds, and can even offer tax-efficient passive income later in life. But with so many options out there, how do you pick the right one? Two of the most popular choices are SCHD and DGRO, and I've had a few questions to compare them. So in this video, I'll break down their key differences, strengths, and weaknesses to help you decide which one might be the better fit for your portfolio. Naturally, both of these funds invest in dividend-paying stocks and are passively managed, but they take different approaches that you should be aware of. The iShares Core Dividend Growth ETF, DGRO, focuses on companies known for growing their dividends over time. These stocks typically have lower yields on average, but they try and make up for it by consistently increasing their payouts at a faster rate. This idea tends to help put upward pressure on the share price of the companies. On the other hand, Schwab's U.S. Dividend Equity ETF, SCHD, prioritizes dividend sustainability. Its goal is to track the Dow Jones U.S. Dividend 100 Index, which only includes stocks that have paid dividends for at least 10 consecutive years. From there, companies are screened based on four key fundamentals: cash flow to total debt, return on equity, dividend yield, and a 5-year dividend growth rate. Now, let's start with the basics. If you're just looking at dividend yield, SCHD has an edge. As of early 2025, SCHD boasts a reported dividend yield of 3.57%, while DGRO comes in at 2.18%. That's a noticeable difference for income-focused investors. This difference stems from the fact that SCHD focuses more on strong dividend-paying companies with an established track record. You'll find plenty of stocks in SCHD with yields above 3% and dividend growth rates below 5%. Meanwhile, you'll find plenty of companies in DGRO that have a yield below 1% but an annualized dividend growth rate above 10%. Both funds are well established and managed passively. SCHD has over $67 billion in assets under management, more than double DGRO's $31 billion, but both are large, reputable funds with solid track records. SCHD has been around since October of 2011, and DGRO launched in June of 2014. SCHD has a lower expense ratio at 0.06%. DGRO comes in slightly higher at 0.08%, but in reality, the difference is barely worth worrying about. For example, if you had $100,000 invested, you'd pay about $20 more per year in fees with DGRO. Hardly a deal breaker. When it comes to diversification, DGRO holds around 408 companies, while SCHD is more concentrated with just 102 holdings. So at first, it might seem like DGRO is more diversified. But due to the different ways these funds select their stocks, that diversification doesn't necessarily lead to lower volatility. This is where the beta comes into play. Beta measures how much a stock or fund moves in relationship to the overall market. A beta above 1 means the stock is more volatile than the overall market, while below 1 means it's less volatile. Both SCHD and DGRO have a beta value below 1, and they're pretty much identical. So despite the differences in the number of holdings, their day-to-day price swings are quite similar. I'd like to take a quick moment here to say I'd really appreciate it if you could hit the like button, consider subscribing, and leave some comments below. It really does help the algorithm and help support the channel, so thanks for that. Now, Let's talk about those holdings. DGRO's top 10 holdings make up over 26% of the fund and include big names like JP Morgan Chase, Johnson & Johnson, Broadcom, AbbVie, ExxonMobil, Apple, Microsoft, Procter & Gamble, Home Depot, and United Health Group. SCHD's top 10 holdings make up a larger portion, over 41%, and includes companies like Pfizer, BlackRock, Coca-Cola, Amgen, Cisco Systems, Bristol-Myers, AbbVie, Chevron, Home Depot, and PepsiCo. Even though both are quarterly dividend-paying ETFs, according to the ETF Research Center, the funds only overlap by 16% by weight. So, while there are some similarities, the funds have very different portfolios. Now that we've covered some of the key differences and similarities between the two funds, what probably matters most to you is their performance. Using the portfolio visualizer, we can compare the two funds over the entire period where they've both been around. Since DGRO has only been around a little over 10 years, let's just check out the last 10-year period. If we look at the performance of just the share price without factoring in any dividends, DGRO comes out on top. $10,000 would have grown into $21,652 in SCHD and $24,706 in DGRO. The compounded annual growth rate for SCHD was 8.88% and DGR was 10.47%. Over that same period, the worst year for SCHD saw a decline of 5.51%, and DGRO's worst year was 7.85%. But SCHD closes the gap by delivering better dividends. When you factor in the dividend reinvestments for the two funds, they're pretty much similar over the 10-year period. But DGRO still pulls ahead just slightly. A $10,000 investment would have grown into $29,095 in SCHD and $30,606 in DGRO. The compounded annual growth rate for SCHD was 12.48%, and DGRO had one of 13.11%. Things shift a bit when we look at the past 5 years. Here, SCHD slightly outperforms with a compounded annual growth rate of 11.26% compared to 11.04% for DGRO. Also, the worst year for SCHD during this period saw a decline of just 3.23%, while DGRO's worst year had a drop of 7.9%. For one more comparison, when comparing the passive income delivered, SCHD is the clear winner. Just consider this example. For a balance of $500,000 invested in each, SCHD would provide $1,487.50 per month in dividends, and DGRO would provide $908.33 per month in dividends. Thus, SCHD would provide more monthly cash flow to support your financial needs without the need of selling any shares. There's one more important point to consider. You might already have the SP 500 or maybe the total market fund as the core holding of your portfolio. It's worth noting that SCHD only has about a 7% overlap by weight with the SP 500, while DGRO has a 43% overlap. So if you're pairing one of these with the SP 500 or the total market fund, SCHD would give you better diversification. That said, both of these funds are solid choices with a strong track record. DGRO has delivered better price appreciation, but SCHD makes up for it with stronger dividends. And of course, there's nothing wrong with holding both of these. I hope this breakdown has been helpful and helped you understand the similarities and differences between these two funds. If you found this quick comparison helpful, please hit the like button and thank you for watching.